true open is a concept that very few traders use, but it's one that can completely change the way you see the market. It helps you spot manipulation and identify strong support and resistance zone with precision. In this video, we'll break down why the true open is so important, how to find the areas that can act as a support and resistance, and how to recognize market manipulation. And also I have developed an indicator that makes it much easier to identify all of these elements on your chart. Let's break it down. So, when we talk about true open, we are talking about the real opening price of a specific trading period. It could be a day, a week, a month, or even a session. Why is it important? Because the true open gives us a clean reference point. Around this price, you will usually see a lot of activity and a lot of liquidity. That's where big players position themselves or start creating traps. If you watch how price behaves around the true open, you can often tell where there is a manipulation going on or if the market is preparing for a directional move. For example, if price pushes hard below the true open and then quickly drops back above, that might signal a fake breakout or liquidity grab and probably was front manipulation. So basically the true open shows where the market really starts moving. Watch how price reacts there, who defends it, who pushes through it, and you will often see the real intention behind the move. Now I will show you how to use it effectively. To use true open effectively, it's important to understand that the line itself doesn't always cause a reaction. The reaction usually comes from the first fair volume gap that forms after the true opens. First, pay attention to the true day open and true weekly open, and the first fair volume gap that appears right after it. This gap often marks an area of imbalanced liquidity, where price may later react. It can bounce if the area is defended, or retrace into the gap to fill it before continuing into original direction. Second, if you are trading short-term or intraday, you can apply the same logic to the sessions to open and its first fair volume gap. These early session gaps often provide some of the cleanest reactions, and they highlight where initial buying or selling pressure create an imbalance right after the session started. Okay, let's break down this example. We can notice a true day open, and right after that, a strong gap forms. We mark this first gap because it can later act as a support or resistance for us. Then comes the London session, and throughout the entire session, this gap holds the price. After that, the market reverses and moves down. Moreover, if we look at the next day, we can see a retest of this area once again. Also, it's important to make a small note. We should always pay attention to the size of the first gap. If the gap is too small, it will not have as much strength or significance in the market. We can see the true day open, and right after that, a small gap was formed. It looks quite weak. The indicator marks the first gap by default, but we should pay attention to the stronger gap. If we look at the next gap, it's much larger and stronger. That's the one we mark. Now let's talk about timing. When each trading opening occurs. Personally, I separate them into two types. The first one is the long-term true openings. These are stronger levels, and the price can react to them multiple times and use it as a support and resistance level. The second type is a short-term. These are used within a single session, and they are not as strong as the long-term ones. That is, we use them during the session. The first and the highest type of the opening is a monthly open. It occurs on the second Monday of the month at 6 p.m. In other words, we skip the first week of the month and wait for the second Monday at 6 p.m. The second type is a weekly open, which forms on Monday at 6 p.m. every week. Then we have the true day open, also known as a midnight open, which occurs at 12 a.m. every new day. All times mentioned are based on the New York time zone. Now moving to the short-term levels. First true Asian session, 7:30 p.m. Then true London open, 1:30 a.m. And true New York open is 7:30 a.m. The idea behind the true open is simple. Basically, we look to buy when the price below the true open line. We look to sell when the price above it. However, we don't just buy or sell anywhere. The market always moves with intention, from point A to point B. Every move has a target. For example, if the price is above the true weekly open and reaches an area of interest, such as an end-dog, fair volume gap, or maybe discount area, or another key zones on the daily time frame, then once that area is filled, we can consider selling. The same logic applies at the opposite direction. When the price is below the true weekly open and it reaches a downside target or fills a zone of interest, it may provide a buying opportunity. Personally, I use true open to identify manipulations, because before the market moves in the intended direction, it often manipulates first. Of course, it's not easy to buy when you should or sell when you should. That skills takes time and practice. But with consistent observation and experience, you can train yourself to recognize the setups naturally. So the first time, I can recommend you to focus on the first fair volume gap at the support and resistance area and find manipulations using true opens. To make identifying these elements much easier, I have developed an indicator that highlights the true open and the first fair volume gap. It displays the daily, weekly, and sessional true opens, as well as the initial range, the first hour's range after the true open and weekly open. In the settings, you can customize which elements to display, so you can adjust it for your own comfort and workflow. I will leave a link to this indicator in the description. Okay, right now let's break down some examples. Let's take a look at this example. Many traders prefer to trade the NQ during the New York AM session. And before the New York session opened, we can see that the market was consolidating around the 2-day open. Then we had this kind of manipulation. The market pushed the price higher, touched the previous 2-day open first gap, and then rejected downwards. Now, if we switch to a lower time frame, we can notice that right after the New York open, the first gap was formed. What we should do is wait until the price comes back to test this gap before opening a position. Once the price touches this gap, we need to wait how it reacts, whether it breaks through it or bounces off it. As we can see here, a reaction was formed. So in this case, it was possible to open position from the gap. After the touch, the price continued to move lower. Personally, the easiest way for me is to determine market manipulation is when the price consolidates near true open, and then there is a sharp breakdown and reversal, like in this example. Now let's take a closer look at this example in detail. The movement begins from the true weekly open, where the first fair volume gap forms shortly after the market opens. At this stage, price starts consolidating around the area, showing the liquidity is building up near the true weekly open. This consolidation often signals that the market is preparing for a directional move. After a period of ranging behavior, we see a break to the downside, indicating a temporary shift in the market structure. However, when we switch to a high time frame, it becomes clear that price has entered in the discount zone, an area where buyers typically becomes more active, seeking volume increase. From that zone, price begins to reverse to the upside, showing a clear bullish reaction. During this reversal, the true weekly open fair volume gap is broken, confirming a change in momentum. Following the break, price retests fair volume gap level, reacting sharply to it before continuing higher. This strong reaction demonstrates the importance of this level as a point of interest, and after the retest, the price went up. And in the last example on the Euro-USD pair, during the London session, we can see that the price moving toward the first fair volume gap after true open. It's noticeable how the price reacts to this level. It rejected and fails to hold above. Larger upper wick showed that the market attempted to push higher but couldn't close above the gap. After that, the price reversed to the downside. Later, the price reacted to this gap several more times, showing repeated rejections. Overall, a potential entry could have been taken after the price broken below the gap and then retested it. That will provide a clear continuation setup in line with the downtrend move.